Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Natural disasters can change a lot of different things, and insurance companies can be in a difficult spot trying to cope with so many claims. This is what we're watching unfold, of course, in California, and along with, in the markets front, the latest jobs report out of the US this morning. This has overall dwindled the hopes of a rate cut by the Federal Reserve later on this month. Not that it was really expected, but it's dwindled it further, and also thrown markets overall into a bit of a spin. So we will Canadianize some of these market moves, with the rate story moving higher here as well, also on jobs data, and take a look at the real estate and insurance companies du jour and how they are evolving. Where is our next guest finding opportunities in today's market environment? Happy to say joining us here to unpack the latest trends and opportunities in Canada's insurance and real estate sectors is Equity Research Analyst Connor MacGrath. Welcome back. Great to see you, Connor.
Great to see you as well. Thanks for having me.
So let's dig in. We'll invite everyone to send their questions in over the next half hour or so. Dig into what everyone is watching, which is these unbelievably upsetting images of the wildfires. Yes. You'll watch the human element, then where does your brain go? You're analyzing the insurance story.
Yeah, and my brain immediately goes to, within the companies I cover, what are their exposures to that specific market, and trying to find basically every piece of data available that I can. And so I can then synthesize that into some kind of potential outcome on this company's earnings profile. Is their balance sheet going to be okay? And then I can relay that to our portfolio managers who may hold certain stocks that may have exposure to these areas, and helps kind of sensitize different outcomes and scenarios for them so that we can make potential adjustments to our portfolios based on our view of what we think may happen, or a range of outcomes in terms of how bad things could actually get.
So when you watch this type of unbelievable disaster going on, fire related, in the middle of California, in the middle of one of the oldest cities in the United States, versus, for instance, the Alberta horrifying wildfires, which was unbelievable for Canadians to watch. What's the difference? I mean, they're both just uncontrollable blazes.
Yeah, and there's a lot that goes into that. I mean, there's some companies I cover that will only have Canadian exposure to fires in, let's say, in Alberta, and they won't have to deal with anything in California or the United States. And so I can basically put those to the side and focus my efforts on the ones that do have, let's say, exposure across the border or across multiple areas. And it's really interesting because when you think about the fires in Los Angeles, these are happening in a very concentrated area of the city in terms of very high value homes. Areas where they're potentially at high risk of wildfires, and there's certain areas in Alberta, let's say, where wildfires are maybe lower risk and companies maybe aren't prepared for those. And so you really have to sort of tailor it to what the specific event is, why it's happening, and where exactly it is unfolding and how bad it can get, based on what city it's in, the topography of that city, and how the companies have sort of adjusted and positioned themselves to account for that.
And how much people are paying for their insurance.
Yeah.
It's quite different
It's
in the middle of LA to what you're paying in another jurisdiction. I mean, just kind of go there. Like, what happens to the claims story here?
It's really interesting in California because the last few years we've actually seen very publicly some very large insurance companies have actually pulled out of the California homeowners market. They basically have said to people, we can't have a viable business model insuring your homes in these areas, and we have to drop coverage, unfortunately. And it's really unfortunate for homeowners because then you're left scrambling to find replacement coverage,
and it goes up.
And it goes up. And the government of California has tried to step in with a backstop insurance program as well, but even then that may not be sufficient to cover a home that in Pacific Palisades that costs $5-10 million, right? And so and we've seen this in Florida with hurricanes on the coast. And again, I think it kind of speaks to the evolving risks facing these companies, but also facing other stakeholders like people who live in these homes, local governments, regulators, and how we have to deal with these. And it seems like there needs to be kind of a continued cooperation and coordination between both public and private sectors so that we can kind of try to avoid these really horrible, tragic outcomes that we're seeing right now in Los Angeles.
So unbelievable. Okay, so let's go through. You also cover real estate.
Yep.
Both of these are extremely interest rate sensitive industries, and that's kind of actually what we came to talk about today.
Yes.
But the fires are now ahead of that. There is a huge rate story going on. We just got jobs data, both sides of the border. We know what that's done to the yield story. For real estate, what have you been watching for some time? Just sort of summarize the real estate story for the last sort of 6 months, and maybe what you're getting ready for.
Sure, yeah, and to sort of lay it out, I mean, the simple way to think about it is higher interest rates are bad for real estate. And so the last few years, we've seen, these stocks underperform the broader market as we've seen higher interest rates. These companies are very capital intensive. They run with a lot of financial leverage. And so that's really impacted their business models and their earnings power. And so, rates spiking up like today aren't good for real estate stocks, unfortunately. But I think what we spoke about last time I was on in October is that, there is a lot of dispersion within real estate. We can't paint it with a broad brush. We have to sort of dig a little deeper into the different subsectors within that. And there are some interesting stories, right? We spoke about data centers last time. We spoke about retail real estate actually doing really well. But then on the opposite side, things like office, is still having its troubles and issues across different markets there. And so, there are opportunities within them. You just have to look a little further to find them.
So what has kind of evolved on that front? Because we know rates have come down. We've got a big cut in the US. We've had several in Canada. Throughout the end of 2024, it was a story of rates being cut and adjusting for that, basically. What's changed in the last couple of months for what you're looking at?
So it's interesting. I mean, I'll give you a bit of a disappointing answer, and the answer is not a lot. Real estate's a very slow-moving space. Not a lot changes, but I think a lot of the same trends we spoke about are still very much in place, and so the opportunities I think are still very much there. And we've seen really good jobs reports, and the U.S. economy seems to be doing pretty well, and so that is a good backdrop. But obviously the rate story has been volatile, and that can kind of introduce volatility into these stocks, but that can also create opportunity as well for us as investors.
Right. I mean, when you're looking to sort of the promised land or what's being priced a few months out with having this many rates under their belt for all these different companies on the real estate side, what's being priced in sort of down, I don't know, midterm?
I think what's being priced, is, there are certain sectors where fundamentals are improving. We've maybe exited, a COVID pull forward period, and we're now kind of at a more normalized period of demand and supply. And I think certain sectors are showing that we're starting to exit that and potentially becoming interesting. Whereas others, like office, where you're still seeing workplace and office utilization that's still well below pre-COVID. People just aren't going back to the office as much, and companies are really struggling to adjust to that. And so I think what's interesting is that there are certain sectors where there is light at the end of the tunnel, and we are seeing some interesting opportunities. But then there's others where perhaps those stocks aren't priced for what could be a continued pain for the next few years.
Okay, really interesting. Back to the insurance side of things, higher interest rates, and things have been sort of stickier. There's the whole higher for longer story in the market as well. Bring us up to date on insurers from that perspective. We'll come back to the claims and the fires in a minute. But.
Sure. So, if real estate companies don't like higher rates, insurance companies really like higher rates. And so, I sell you a policy, you pay the premium up front. I'm the insurance company, I don't have to pay out your claim for a few years, and so I can invest that money up front into government bonds or corporate bonds. That increases my earnings power if rates go higher, and the stocks have gone higher, and they've outperformed for the last few years, and so higher rates are good. And these companies have done a good job of locking in that higher interest income for the next few years and sort of preserving that earnings power. And they're the ones that they derive a lot of their earnings from investing in interest rate sensitive financial products like bonds and corporate bonds and mortgages and things like that. And so broadly speaking, higher rates are going to be good for these companies.
Has it been priced in? I mean, have we seen that has run, and that's been a really interesting one to follow. To what extent is it baked in? I think
consensus estimates definitely do capture the upward move in earnings estimates and earnings power, I should say. And we've seen that for the last few years. We're big believers that stocks follow earnings, and so but at the same time though, consensus maybe isn't always right. And again, we're always looking for opportunities where there's a mismatch between our expectations for a certain company and earnings power and what consensus has, and there are still opportunities out there where maybe not all of that has been baked in. And I think it again really speaks to the muscle that we have on our research platform, where we're able to sort of go company by company and sort of figure out where those opportunities are a bit mispriced.
So when you're watching, for instance, insurance stocks right now, you're seeing what's into them. It is sort of the interest rate story. It's been very helpful ultimately. Then you see this story of everyone's going to need insurance in a new way, but also these companies are going to get hit by claims. Just take us through that sort of Yeah, it's a bit of a bifurcation of pieces that fit into the stock price.
Yeah, and when we think of how insurance companies make money, the one piece of it is I invest my float into bonds and whatnot, and I earn an income there, and then the other piece is the actual underwriting income. How much money do I make per policy that I sell and whatnot, in terms of how many dollars of claims do I have to pay out, and that's where I think that's where the real differentiation and the real stock picking comes in, because every company is so different, and it's such a big universe. Where even the Canadian companies I cover, they play in so many different lines of business that you really have to do the work to figure out where's the exposure, what are the certain conditions that are present within that line of business, and how is that going to impact the company's margins that it earns on products that they sell. And I think that's really where the opportunity is to really figure out where there's a gap, let's say, in expectations, and those are the opportunities that we want to take advantage of.
Insurance companies, the big ones, have hoovered up smaller insurance companies, and that's been kind of the way they operated for a very long time. Are there adjustments in that sort of acquisition because some of the companies they may have thought they wanted to buy a year or two ago are watching some of these natural disasters? I mean, is that shifting?
Yeah, and that happens a lot. I mean, you'll oftentimes see, one insurance company buys another, and they may non-renew a bunch of policies that they acquired from the previous business. Let's say if they had a lot of exposure to a certain high-risk area for floods or wildfires, they may not really like that exposure, and so they're maybe going to try to shift and adjust their exposure so that, if a left tail event happens, they're not totally exposed, so they don't compromise their balance sheet in some way.
I always find the research that insurance companies do incredible, because they're looking at so many pieces of actually a demographic story in a lot of cases. How has that shifted? I'm sort of getting at, for instance, Toronto has flooding issues, and the research is really trained on that, and I'm sure that they insure differently in certain areas. Just speak a little bit to how that has developed as well.
And I think insurance companies are really interesting because they have access to trillions of data points in terms of claims that come in, and when they sell products to customers and whatnot. And they have very sophisticated data sets and ways that they can model scenarios. They're big users of AI and machine learning and whatnot. And really what they're trying to do is understand that these risks that they're facing, whether it's floods in Toronto or wildfires in California, they are evolving, and they have to evolve in terms of how they position themselves. And it goes down to modeling all the way down to if there's a specific house that we want to insure here, but we maybe don't want to insure the one beside it because it sits a little higher up elevation wise, and that puts them at bigger risk of XYZ weather event or whatnot. And they can get incredibly granular, and it's really interesting when you talk to them and they can give you very tangible examples of how over time they've become a lot more sophisticated in how they underwrite and price risk.
So interesting, and they probably also involve in that the story of immigration, which is caught in the sort of political shifting sands right now, for sure. But it's something that both industries will likely have to adjust to. On the real estate front, how is immigration impacting either way? It's slowing, we think, in Canada. What does that mean for real estate?
So, I mean, the last few years, we've had obviously very outsized population growth, and I cover apartment landlords in Canada, and they have been a big beneficiary of outsized population growth. More people when they come to Canada, higher propensity to rent instead of buy a home, and so you're going to need somewhere to live, and that's been great for those companies. And you can basically flip that on the opposite end if, let's say, immigration is going to be a lot lower or population growth is going to be a lot lower. That could be a detriment to them in terms of just one less person coming to the country or coming into Ontario or Alberta that needs a place to stay and is looking to rent one of your available apartment units.
So in theory, prices come down.
Yes, in theory, yeah. And we've also seen, we always talk about, a longer term kind of structural housing deficit in Canada, which we do have.
Right.
But in certain cities, we actually do have oversupply in certain pockets.
Which cities?
Toronto, Vancouver, parts of Alberta, Montreal, so most of the big cities.
So that's not consensus.
No, and what's really interesting is it's not necessarily purpose-built apartment rentals. It's condo units. We had a big boom in condo construction during COVID. A lot of those buildings are now just being completed, just based on how long it takes. But what's happening though is a lot of those units actually, when they get delivered and completed, the owner isn't actually occupying the unit. They're usually going to rent it out to someone. And that in turn is competing with a lot of the existing apartment units that are potentially vacant on the market. And so everyone knows the basic supply and demand fundamentals in economics. And so that is putting pressure on certain markets within Canada.
The rate story, bring it into and layer it on top of that. So we have Canadian rates coming down, although from sort of a mortgage perspective, it hasn't really been felt in a lot of ways. There's a lot of renewals. That's more the buying up, not the rental market, but there's a real trickle through.
Yeah, and when you think about it, I mean, there are still affordability issues within the rental market. When you think of, we look at them on a rent-to-income ratio in terms of, on a per month basis, how much are you paying out? And those are still quite restrictive, unfortunately, in some cities, right? In Toronto and Vancouver, and it does create pressure on the consumer, and it does impact their decision in terms of, do I want to live in a 1-bedroom by myself, or maybe I live in a 2 or 3 bedroom with some roommates, and they can maybe help ease the cost of living and whatnot. So we are seeing things like that, and with interest rates as well, that does impact, what kind of value are we going to put on this apartment building? The willingness for people to transact and buy and sell apartment buildings and capital to flow into the industry. So it has very far-reaching implications. It affects, not only the owners of real estate, but the users of real estate, capital providers to real estate. And so those are all things that I have to take into consideration when I'm talking to my PMs on that topic.
Is there clarity? I mean, there's this argument that things are a bit frozen, so it's hard to, the price discovery still kind of needs to happen.
Yeah, and we've been in this kind of frozen period for the last few years, and there are maybe some early signs that we're starting to thaw a little bit. And it's very much momentum driven, right? More transactions means more transactions, which means more transactions, and that only improves pricing. And so all it takes those first few to happen, and there's a lot of friction, unfortunately, with those first few, and so you just have to get over that initial hump. And unfortunately, rate volatility doesn't usually help at all, because it does introduce some uncertainty into your cost of financing associated with a certain asset or whatnot. But we are maybe beginning to see signs that we're thawing a little bit.
On the commercial, on what you discussed last time, data centers, is there sort of the large warehouse plots of land ultimately that could be used for things like that? There are a lot of pieces that go into the equation of that. Has that shifted at all from what we spoke about a couple months ago?
At a broad level, no. I mean, there have been some developments. Alberta, had sort of talked about a very large, ambitious target for introducing data center development into the province over the next few years. But again, I mean, I think it's still early days in terms of, companies kind of actually putting out tangible plans in terms of how they intend to participate in that and whatnot. But the potential is still there, I think, and the opportunity set is still there. But obviously, I think it will take time for things to sort of come together because, there are a lot of parties involved, and it's going to be a lot of coordination and a lot of effort and a lot of capital that's going to be required to capitalize on this. But the fundamental sort of story, though, there hasn't changed.
It hasn't really changed. Yeah. So on the commercial, take it into the commercial, and also sort of the office side of things, again, a bit frozen, or are we seeing that starting to move?
And what's interesting is, in 2022 and 23, we saw this sort of wave of, return to office kind of initiatives across companies. And I have access to data where I can track, office utilization levels across different cities. And, that data is collected through, your badge swipe. When you come in, you type wipe your badge, and then you enter the office and whatnot, or it pings cell phone data downtown or things like that. And what we've unfortunately seen is that over the last, let's say, 12 or 18 months, that's really stalled out. We made a lot of progress, and then it just kind of flatlined at a certain level. And so, what we're seeing there is, people have sort of gone back and coalesced to, 3.5 days a week in office, but it hasn't really shown any kind of budge to go back to 4 days a week or 5 days a week.
And that is affecting office REITs in what way? I mean, they're getting ready for that to be a bit of a new normal?
Yeah, and I think definitely a new normal, and I think, there are still large users of office space that haven't made final decisions in terms of, do we need to use more space? Do we need less space because, people aren't going to be back in the office as much? We saw...
Or different space.
Or different space,
What if they were to choose a different space, what is that conversation looking like right now?
So that's really interesting because, we are seeing a big bifurcation in terms of, the trophy, AAA real estate office buildings. Those are doing really well. Those are like very low vacancy, low availability in those buildings, very high demand. Whereas a lot of the older buildings, they're maybe, not on a subway line, or they're not very close to transit lines, whatnot, those are really struggling. And so what you're seeing is people want, the new building with really nice amenities and good restaurants nearby and they have energy efficiency
Some sort of
certifications.
rating on that,
yeah, right.
certification.
And they're in close proximity to a downtown core and whatnot, and those are the buildings that people want to be in, and they maybe don't want to be in the buildings that are essentially the opposite of that.
Is that across Canada? Is that also the U.S.?
Yep.
Is there any sort of nuance to point out there? That's
no,
it's
it's funny. It's pretty consistent across different. There's obviously going to be nuances within certain markets, but I think it's something I've seen not only in Toronto, but I've seen in Vancouver, Montreal, New York, other markets in the United States. So it's a very interesting trend, but we are seeing it consistently across a lot of major markets.
It seemed like in Europe that was a conversation a few years back. I think Europe's at a different stage with all of their national budgets on what they can afford to sort of spend and think about green buildings and so on. It's kind of a different conversation, but it was a conversation then. Just any insights, maybe further insights into global REITs and real estate?
Yeah, I mean, I think the way I think we try to approach it is very market specific and very bottoms up, and try not to approach things with too broad of a brush, because again there is a lot of dispersion within the Canadian market versus the US market. And I think the advantage of the Fidelity platform is, we have REIT analysts outside of Canada. We have a US REIT analyst who sits in London, and we have, REIT analysts who sit in Asia as well and cover, the Australian market and Hong Kong and Japan and whatnot. So I think it's, the advantage of our platform is that we can leverage insights across the globe and basically figure out that, maybe this interesting dynamic is happening in Canada, maybe it looks very different in Europe.
Right.
Like office would be a great example of that, where in North America, North America has lagged behind in terms of return to office and whatnot, whereas Europe and Asia were very quick to get back to office in terms
smaller
of
apartments,
tougher to work from home. And so, so that's an example of, maybe not painting it with a broad brush and sort of trying to be a bit more bottoms up and a bit more fundamental to sort of figure out where that dispersion lies.
So that's bottoms up, fundamental. Let's layer on another macro, the currency story, which is related to the interest rate dispersion story. So you have basically, what is a strong dollar doing to the global real estate picture for the companies that you're following, which may well be exposed around the world, or at least to a couple of different markets, and dealing with a higher dollar?
Yes, it's interesting because it affects a lot of my companies differently. A lot of the real estate companies I cover are very pure play Canadian companies, so there's not much. But what's interesting though is that you would think about it, a weaker dollar would actually make Canadian real estate more attractive to a financial buyer, let's say, if you're looking to invest in Canada, right? We have seen evidence of that. There have been some private equity real estate buyers that have been looking at Canadian assets and whatnot, and the currency has been very accommodative for that. For a lot of the insurance companies I cover, while they're, and it seems like this is the case for a lot of TSX listed companies where you're listed in Canada, but you have a very US presence or an ex-Canadian presence. And a lot of my companies are like that, where they derive the majority of their earnings in US dollars.
Right.
And so there's
even if they're located, like even if the actual real estate is somewhere else, they're probably writing either mortgages, like it's probably all done.
Yeah,
the financing is done in the dollar.
And it's more my insurance companies where that dynamic plays out, where you have the great currency translation benefit, where majority of your earnings are in U.S. dollars, but you report in Canadian dollars, let's say, and so that has been a big beneficiary for a lot of those companies. Because the Canadian market unfortunately is only so big, and so these companies over time have sort of branched out into other geographies to sort of expand their footprints and kind of advance their strategies in that way.
So just to kind of finish the loop there, or close the circle, the US dollar story for Canadian real estate companies invested abroad can be good?
Can be, yeah. I mean,
is it mostly good for the? I mean, you want to be an investor looking at the ones that are mostly good, but I mean, how careful do you have to be there?
I think it's interesting because when you talk to let's say U.S. real estate investors, like private equity investors, a lot of people really like the Canadian market. They like the longer term demographics. There's a lot of areas where there's supply constraints to build new real estate, and I think tying it to a weaker Canadian dollar, that's actually good for foreign investment in real estate in Canada.
Okay.
And there are tangible examples of that. And if you kind of put everything else equal, that maybe just makes it a little bit better of an opportunity, let's say, for them to explore within Canada across different asset classes.
Perfect. Okay. So interesting. We've spoken a little bit about retail, but I just want to kind of come back to that, and then we'll finish with insurance. But on the retail front, remember for years we used to talk about the U.S. being over-malled.
Yes.
And that's M-A-L-L-E-D, not another version of that. But And then those things got redeveloped and turned into something else. We do not seem to have the same problem here, but there is a redevelopment of retail space. Just walk us through that a little bit.
Sure. Yeah. In Canada, it's a much less overbuilt market, if you will, and we have a lot lower retail square footage per capita, and our retail landscape is very different. But what a lot of my companies talk about, though, is we met with a lot of them recently as well at some conferences. But they'll have, let's say, for example, excess parking space in one of their shopping centers where we have 100 spaces, we don't really use them, and what they can do is they can get that land, they can basically carve it up, get it entitled and rezone for residential use, and they actually build, let's say, an apartment building or whatnot, and be actually contributors to sort of aiding and reducing housing supply deficit and whatnot. So there are opportunities there where companies are taking advantage of owning really valuable and well located real estate, right? And they can build it right beside a grocery anchored shopping center, for example, right? It makes a ton of sense. Maybe it's right near a new transit line or whatnot. So there are examples of that happening, and I wouldn't be surprised to see more of that occur moving forward.
Okay, really interesting. Finish up on the insurance front for us, as investors are going to be watching with concern for the human aspect of what's going on right now. What do investors need to think about as they're watching these horrific fires, hopefully slowing down, but there'll be an impact ultimately on the structure of how insurance is written.
Yeah, and yet to be determined, the longer term implications for the California market in particular. But I think what investors should sort of take away is that we try to do a lot of homework and a lot of bottom-up work to sort of figure out what is the impact going to be for our companies and how do we want to maybe make adjustments to that, but also think about the maybe more longer-term implications there, and if there are investment opportunities that come about because of that. Let's say if a company has to really pivot its business model, or an industry or a certain market changes substantially, and that creates a dislocation or it creates new competitive opportunities. Those are the sorts of things that we're thinking about, and we're doing the work to kind of get ahead of that.
Okay, that's interesting. So to a certain extent, we're seeing some of the stocks kind of on fire, but going up. But that may kind of even out. And then there might be some opportunities.
Perhaps, yeah. And again, I think it's going to be dependent on company by company, and there is a lot of dispersion within that. And that's, I think, where the opportunity lies, is sort of figuring out where the gap in expectations exists. And if we do our homework and we do enough work, then hopefully we'll be able to find and capitalize on some of those.
Fantastic. Conor MacGrath, thank you for joining us and keeping us up to date on these important sectors that you follow.
Thank you.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed, their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again, and see you next time.